Hey guys, welcome back to the channel. My name is Chris, and in this video we're going to talk about stocks and taxes. How much Uncle Sam is going to take from your profits. Many new investors or many investors that have been investing for a little bit or for a short amount of time always have questions how they're going to get taxed when it comes to their dividends or their capital gains. Well, the purpose of this video is to make sure you watch this video all the way through and all your answers are going to be answered right here in this video, okay? So I'm going to break this down into three different sections, okay? It's going to be dividends, everybody's favorite type of profit and income, dividends and how they are taxed. Then I'm going to talk about capital gains and how they are taxed. And at the very end, I'm going to do a small Q&A on the most commonly asked questions when it comes to stocks and taxes, okay? And just a reminder, in my channel, I like to talk about financial independence and investments. If that's something you guys do enjoy or if you find any value in this video, make sure to subscribe to the channel, hit the notification bell, smash the like button. It helps me out tremendously like you won't know. All right, guys, thank you very much for smashing the like button. Now let's get on with the video. All right, guys, so let's start this video off with a punch. Let's talk about dividends. This is everybody's favorite type of profit, everybody's favorite type of income, okay? And for those of you that don't know what a dividend is basically a distribution of profits by a corporation to its shareholders, okay? So when the corporation or the company you own makes a profit, it pays a small percentage of that profit to its shareholders. So you're basically getting paid for owning a share of a company. But as an investor or somebody that's thinking about going into the stock market, it's very important to understand this point I'm about to say right now. There's two different types of dividends. There is ordinary dividends and qualified dividends. It's very important to understand the difference between the two because they get taxed very differently, okay? So let's start off with ordinary dividend, okay? Ordinary dividend is the most common type of dividend, okay? Anytime a corporation pays its shareholders, that's already considered ordinary dividend, okay? And how they're taxed like it's ordinary income. So that means depending on how your tax bracket is, will also depend on how much taxes you will pay on your dividends. Okay, let me explain. If you're in a very low tax bracket, you're going to pay very low taxes on your dividends. And vice versa, if you're in a very high tax bracket, you're going to pay high taxes on your dividends. That makes sense, right? And qualified dividends is the most favorite type of dividends for every investor, okay? Especially long-term investors, okay? Why? Because you could get taxed from 0 to 15 to 20% in taxes, okay? And that is very low compared to how ordinary dividends will be, okay? I'm gonna show you an example later on in the video, okay? And the definition of qualified dividends is a little tricky, but I'm gonna explain to you. I'm gonna read you the definition right now though. The investor must hold or own a stock for more than 60 days during a 121-day period that begins 60 days before the ex-dividend date to be considered as qualified dividends. I probably just lost half of you, but let me explain it and let me just simplify for everybody. If you hold the stock for a very long time, it's considered qualified dividends. Simple enough, right? If you hold a stock for a certain amount of time, for a long period of time, more than a year I'm talking about, it will be considered qualified dividends, okay? It's basically like ordinary dividends, but it has to meet a certain type of criteria. One of the rules is it has to be a US-based company and it has to be in the US stock exchange, okay? It could be a foreign company, but that foreign company has to be located inside the United States and it has to have like a certain type of agreement with the IRS and the Treasury to make sure that foreign company is getting taxed like it's supposed to be getting taxed, okay? There's certain stocks that just aren't qualified. For example, MLPs and REITs, okay? For example, those companies or those specific type of stocks, they're not considered qualified. So if you own a REIT, you're gonna get taxed like it's ordinary dividend, okay? So it's very good to like own companies that aren't considered qualified, but you hold them for a long time. That's why long-term investors, long-term dividend investors hold stocks for a very long time and pay very low taxes on them. So now, let me throw some numbers at you, okay? A qualified dividends, you pay 0% in taxes if you make $40,000 or less if you are filing as a single person, okay? Or you still pay 0% in taxes if you're married and you have $80,000 or less, okay? Or if you're the head of the household, you pay 0% in taxes if you make $53,600 or less, okay? That is great to know. Awesome. In qualified dividends, you pay 15% in taxes if you make between $40,000 to $425,000 if you're filing as a single person. If you're married, if you make anywhere between $80,000 to $460,000, you're still going to pay 15% in taxes. Or if you're the head of the household, if you make anywhere between $43,600 to $496,000, and if you're the head of the household, you pay 15% in taxes, okay? Any more than that, if you're surpassing those numbers, you're gonna pay 20% in taxes. But compared to ordinary income and ordinary dividends, you're gonna pay way less in taxes if you just have qualified dividends, okay? Let me give you guys an example. If you have $420,000 and you're filing as a single, you're gonna pay 15% in taxes on your dividends, okay? But if you have ordinary dividends, if you're making $420,000, you're gonna get taxed anywhere between 30 to 35%, all right? The difference is 15 to 20% in taxes, okay? That is a very big difference just by having qualified dividends. So you see, long-term investors usually they strive for qualified dividends because they're gonna get taxed way less, all right? I love qualified dividends too. So now let's talk about capital gains. A capital gain is basically anytime you sell for a profit when it comes to your stocks, okay? Or when your stock moves up in value, that's also considered capital gains, okay? Let me give you an example. If you buy a stock for $20 and that same stock or company shoots up to $50, your gain or your capital gain will be $30, all right? Makes sense? So if you sell that stock, you'll get the $50 and your capital gain, your profit will be the $30. That'll basically be your capital gains, okay? And just like dividends, capital gains has two different types. There's short-term capital gain and long-term capital gain. The only difference is how long you hold your stock. For example, if you hold the stock for less than a year, that's considered short-term capital gains. And if you hold it anywhere for more than a year, it could be a year and a day, that's considered long-term capital gains. And they get taxed very differently. Short-term capital gains gets taxed like ordinary income or ordinary dividends. Long-term capital gains, you'll get taxed like qualified dividends, which is really good. It's called capital gains tax. So you see, holding a stock for a very long time and being a long-term investor has its perks. You get taxed less, all right? And if you kind of want to go through the numbers again, you could either go back into the dividends and see the same numbers, but you can also go down to the description. I'm gonna put the numbers down for you so you guys don't have to keep clicking back and forth throughout the video. I'm gonna have all the information, all the numbers down below in the description, okay? So you can kind of see the numbers on how the long-term and short-term capital gains get taxed as well. All right, guys, now in this part of the video, I wanna do a basic Q&A of the 3 most commonly asked questions when it comes to stocks and taxes, okay? And if I haven't answered your questions yet throughout the video, I hope these 3 questions answer any questions you have left, all right? So number 1 being, do I have to pay taxes on my capital gains if I have not sold my stock? Okay, that is probably the most common question that everybody asks, okay? And the answer is no. You don't pay taxes on something you haven't really made a profit in. You make a profit when you sell and you get your money back, right? And there's 2 different things. There's a realized gain and an unrealized gain, okay? If you have not sold your stock and your stock has made you $100, you don't pay taxes on it. That's unrealized because you haven't really technically made the profit yet. You haven't taken that money out, okay? But if you did sell the stock and you made $100, that's called a realized gain, and you will pay taxes on the $100 profit that you made on your capital gain. The second most commonly asked question is, if I sell a stock for a loss, what happens? And that's a very good question. Many people, always ask that question. If you sell a stock for a loss, nothing happens. You can't get that back. You can't write that off. Nothing happens. But what you could do is you could use that as a reduction for your capital gains that will get taxed, okay? For example, if you make a capital gain of $20,000 in last year and you've made a loss of $15,000, your net profit is $5,000, right? So you will only get taxed $5,000. So you could use your loss as a reduction for the profit that you've made, okay? It's very sad you made a loss on your stocks, but it's a good advantage if you are making capital gains profits anywhere else. And the third most commonly asked question is, how do I avoid paying taxes on my capital gains and my dividends? Which is understandable. Everybody hates paying taxes, but Uncle Sam likes his cut. Okay, so you can't really avoid it 100%, but what you could do is you could lower your taxes. How do you do that? Hold your stocks long term. Make sure they are qualified. Make sure you're not getting into REITs or MLPs, which I'm not saying it's not a good idea to go into them, but I'm just saying, why pay more taxes on some companies when you could save some money? Again, the percentages of ordinary dividend and qualified dividends, or long-term capital gains and short-term capital gains, is very, it's this much of a gap, So it's always good to be a long-term investor and hold your stocks long-term. You can also do the loss deduction, okay? So every time you sell a stock and you make a loss, you can write that off for any profits that you are making. So therefore, you're lowering your profits, when you do your taxes, and you'll get taxed a little bit less. So you'll be paying less money out of your pocket when it comes to that aspect, okay? Or what you could do is put your money into a tax-free account, like the Roth IRA, okay? Anytime you put your money inside, you won't get taxed on that money. I hope this video answered all your questions relating to stocks and dividends, okay? And if you didn't, and if it didn't, if you're a little still confused, make sure to rewatch the video and you'll get a better understanding. If not, I'm gonna be a little bit more detailed down in the description, a little bit more specified with the numbers, with the difference between capital gains and dividends and ordinary dividends and what's qualified dividends. I'm gonna be a real more specific down in the description. I know the video was a little bit brief, but it was just to give you guys a basic idea and to answer most of the commonly asked questions when it comes to stocks and dividends, okay? I hope you guys did enjoy the video, and if this video brought you guys any sort of value, please make sure to subscribe to the channel, hit the notification bell, smash the like button. It helps the video get pushed out to people that may be needing it. Please enjoy the video. I'm gonna put all my links down in the description for you guys to do your own research just in case. But I hope this video was really helpful. All right, guys, until next time, remember, stay safe, take care.